Can you do a video on VBIL Vanguard 0 to 3 month Treasury Bill ETF? Your portfolio will have at least two silos. First one is the higher risk, growth, business-oriented equity portion. The second portion is the lower risk, non-business, non-equity portion. VBIL by Vanguard falls into the second silo, which is the lower risk portion. It's actually risk-free because they focus on U.S. Treasuries, specifically U.S. Treasuries that mature in 3 months or less. Over here, you can see asset class is considered short-term bond. The government sells these to investors to get money to fund their projects. Risk-reward scale is a 1, so it's the least risk or risk-free asset. The expense ratio is very low, 0.07%. That means you pay 7 cents for every $100 invested in this. It was created a few days ago on February 7th, 2025. The ticker is VBIL.IV. So that's important to you because that's what you're going to type in your brokerage account in order to purchase this ETF. Management style is an index, so it's passive. There's no active management involved here. It just rolls over treasury bills that are 3 months or less in maturity. It's too new to have any performance metrics, but you can probably guess what the yield is going to be. The US 1-month treasury is about 4.3%. Traded in US dollars. And remember, when the interest rate goes up, the value of the bonds go down. And if the interest rate goes down, the value of the bonds go up. The Canadian equivalent trading in Canadian dollars is CBIL. As of February 19th, the distribution yield is 3.21%. Again, this is from a bond, so it's interest income as opposed to dividend income from a company. The fee is a little higher. The management expense ratio is 0.11%. Management fee, which is included in the management expense ratio, is 0.1%. Cost to own this ETF is 11 cents for every $100 invested per year. You can see here everything with a 3-month maturity or less is trading around 2.9 or 3%. Few reasons to hold this. Number one is part of your asset allocation to manage volatility. Let's say you have a 60-40 portfolio where 60% is business, equity, higher risk. 40% consists of the risk-free government bond portion. Another reason to hold it is because cash is just building up and you don't find any good ways to deploy it. So Warren Buffett, he has cash come in from operating businesses, float from insurance. He deploys it into businesses or the stock market if he can find a deal. If he cannot find a deal, the cash piles up and he puts it in government bonds. Another reason to keep it is because it's part of your emergency fund. Again, because it's government bonds, it's considered risk-free. Similar to a high-yield savings account, arguably safer. Fourth reason to hold it is because it is part of your opportunity bucket. Again, if you're seeing an opportunity outside the stock market and you want to keep money safe for that opportunity, you would keep it maybe in government bonds. Opportunities include buying a private business, investing in a private business, starting your own business. And that's a quick summary of VBIL and CBIL. Learn the lessons about money that your friends and family don't know. Download my free newsletter linked off the bio. Good luck. Take care.